Good afternoon, everyone. I hope you're all doing well. The focus of today's lecture is IAS 33, Earnings Per Share. Today, we will largely be focusing on learning outcomes 1 to 6 in relation to IAS 33, Earnings Per Share. You will see that your first learning outcome asks you to calculate, present, and disclose dividends per share. And because dividends per share is not governed by IAS 33 earnings per share, we will be looking at that first. As I said on the previous slide, we will first be looking at dividends per share, as this is not governed by IAS 33, and instead this is a requirement as per IAS 1, presentation of financial statements. IAS 1, paragraph 107, states that an entity must present, either on the face of the statement of changes in equity or in the notes to the financial statements, the amount of dividends recognized as distributions, as well as the amount of dividends per share. Those two go hand in hand as we are dealing with the total amount of dividends and then the dividends per share. Now, the calculation of dividends per share is not very difficult. You just have to be very careful when deciding which dividends to include in this calculation. Very importantly, the dividends per share must be disclosed in relation to the ordinary shares. Therefore, you are actually in essence calculating dividends per ordinary share. The calculation requires you to take the dividends declared and paid and divide it by the actual number of shares that were in issue on the date when the dividends were declared or paid. But what does it mean if a dividend has been declared? It means that the dividend that the directors have proposed has actually been authorized and approved by the shareholders at the annual general meeting. And because the dividend has now actually been authorized and approved, the dividend can be recognized in the financial statements. So we essentially take the dividends recognized in the financial statements and we divide it by the actual number of shares that were in issue when the dividends were recognized in the financial statements. IAS 1 further requires that any dividends which have been proposed or declared before the financial statements have been authorized for issue must be disclosed in the notes to the financial statements. Now, this links to IAS 10, events after the reporting period, which we did at the very beginning of the year. You may remember that IAS 10 has very specific rules when it comes to dividends, and basically any dividends that were declared after the reporting period, but before the financial statements are authorized for issue, must be classified as non-adjusting events, and therefore the effect of the dividends will be disclosed in an IAS 10 note. So because it is a non-adjusting event, we do not go and adjust our financial statements, we merely disclose the nature of the transaction. Now, when dividends are proposed, the directors have basically said, well, we think we should declare a dividend based on how well we've done this year and based on our audited financial results. But at this point, the directors are only thinking about declaring a dividend. There is no firm commitment. They have not stated, we will be declaring a dividend. They are merely thinking about it. When dividends have been proposed, they have not yet been declared. This distinction is incredibly important, as dividends proposed are not used in the calculation of dividends per share, but dividends proposed before the financial statements have been authorized for issue have to be disclosed. Additionally, IAS 1 requires that any cumulative dividend which has not been recognized must be disclosed in a note. Now, when would a cumulative preference dividend not be recognized? Well, it would be when it has not yet actually been declared. Dividends can only be recognized in the financial statements once they have been declared. However, we know, based on prior knowledge, that holders of cumulative preference shares are entitled to dividends even when the dividends have not been declared. But they will only actually physically receive the dividends owed to them, the dividends that are in arrears, when a dividend is actually declared. There are notes and examples on the calculation of dividends per share in your IAS 33 Notes and Class Examples handout if you would like to go over further examples and to gain a better understanding of the theory behind dividends per share. We can now move on to the main feature of today's lecture and discuss the implications of IAS 33 earnings per share. As I said at the very beginning of this lecture, we will mainly be focusing on learning outcomes 1 to 6, which focuses on the calculation of earnings, which is used to calculate the earnings per share amount that is disclosed in the financial statements of an entity. The requirement to disclose earnings per share comes from the standard specifically dedicated to earnings per share, namely IAS 33. The standard specifically states that earnings per share will have to be disclosed in the separate financial statements and the consolidated financial statements of all entities whose ordinary shares or potential ordinary shares trade in a public market, whether it be local or foreign, as well as all entities who have filed or are in the process of filing in order to be able to issue their ordinary shares in a public market. Now, we all know what ordinary shares are. They are shares which represent a stake in an entity. However, they do not provide the holder with a guarantee to any dividends. Now, that's a very loose definition. IAS 33 places a very formal definition to the term ordinary shares, and they state that ordinary shares are an equity instrument that is subordinate to all other classes of equity instruments. Basically, because shares are subordinate, they are at the bottom of the equity instrument food chain. The concept of potential ordinary shares, however, is new to us. IAS 33 specifically defines potential ordinary shares as a financial instrument or other contract that may entitle the holder to ordinary shares. Potential ordinary shares are instruments which have the ability to become ordinary shares. They are not ordinary shares from the get-go, from the time that they are issued. Some examples of potential ordinary shares include options, preference shares, which are convertible into ordinary shares after a specified period of time, or any financial liability which is convertible into ordinary shares. So an example of that would be an entity who issues debentures to the public, and then on maturity of the debentures, instead of paying back an amount of money to the holders of the debentures, these debentures get ordinary shares instead. If an entity meets the requirements on the previous slide, they will have to disclose basic earnings per share in their financial statements. Importantly, the basic earnings per share is calculated with reference to the profit or loss attributable to ordinary equity holders. There is absolutely no mention of preference shareholders, and therefore we essentially end up calculating basic earnings per ordinary share, just as we calculate dividends per ordinary share. But how do we calculate basic earnings per share? Well, basic earnings per share is calculated as follows. We take the earnings and we divide it by the weighted average number of ordinary shares outstanding during the financial year in question. Now, I know the denominator is a bit of a mouthful, so we commonly refer to the denominator as the WANSO, the weighted average number of ordinary shares outstanding, WANSO. Importantly, if you're working with a group and you were asked to calculate the earnings per share for the group, your numerator will be the profit or loss attributable to owners of the parent. Now remember, the profit or loss attributable to the owners of the parent consists of the profit of the parent as well as a portion of the profit of the subsidiary, which we as the parent are entitled to due to our interest in the subsidiary. The focus for the rest of today's lecture will be the calculation of earnings, which is really not terribly difficult, and then tomorrow we will delve into the calculation of the weighted average number of ordinary shares outstanding. The calculation of earnings is generally the easiest part of the calculation of basic earnings per share. The earnings is calculated as follows. We take the profit or loss for the year after tax, it is always the after tax figure, less non-cumulative preference dividends, less cumulative preference dividends. When performing this calculation, you can only deduct non-cumulative preference dividends if they are actually declared. Holders of non-cumulative preference shares are only entitled to these amounts if the dividends have been declared. That is why you can only deduct it if they have actually been declared. On the other hand, the cumulative preference dividends will always be deducted, regardless of whether or not they have been declared. Now, what is the reason for this? Take a second and think about it. Cumulative preference shareholders are always entitled to a dividend, regardless of whether or not it has been declared. That is one of the huge perks of holding a cumulative preference share. And remember, if dividends are not declared, that just means that the cumulative preference dividends are in arrears, but the preference shareholders are still entitled to those dividends in that financial year in which a dividend was not declared. They will just physically receive the dividend in a year when dividends are declared and paid out to all shareholders. Because cumulative preference dividends are always deducted in the calculation, you will only ever deduct the cumulative dividends for the 1 year in question, regardless of whether or not the dividends are in arrears. With the calculation of basic earnings per share, it is incredibly important for you to understand why you are doing what you are doing. So ask yourself quickly, why do we take out the preference dividends? What is the reason for taking out the preference dividends in the calculation of earnings? The reason is that we are essentially calculating basic earnings per ordinary share. And therefore, when we calculate earnings, we want the earnings attributable to ordinary equity holders. And preference dividends are not attributable to ordinary equity holders. Preference dividends are attributable to preference equity holders. So this slide gives you the very basic calculation of earnings. So please remember, you take your profit for the year after tax, you deduct your non-cumulative preference dividends, but only if they have actually been declared, and then we deduct cumulative preference dividends always. We then need to take a look at the concept of participating preference shares. I'm sure you have heard of the term participating preference shares, but what are they? Participating preference shares are preference shares that entitle the holder to a fixed preference dividend as well as an additional dividend based on the ordinary dividends declared or paid. So in essence, shareholders with participating preference shares end up with a greater amount of dividends in comparison to shareholders that hold other types of shares. An example of this would be that these preference shareholders in the specific entity will receive a 15-cent fixed dividend per share on an annual basis, and then they will also receive 5% of the total ordinary dividend declared by the entity. Now, you can have cumulative participating preference shares, and you can also have non-cumulative participating preference shares. If you have cumulative participating preference shares, they will be entitled to their dividends every single year. If you have non-cumulative participating preference shares, then they are only entitled to dividends when the dividends are actually declared and paid. Participating preference shares do have an impact on the calculation of basic earnings used to calculate earnings per share. Basic earnings will still be calculated as per the previous slide, so profit or loss for the year after tax, less non-cumulative preference dividends if they are declared, less cumulative preference dividends always. However, the basic earnings will then be split between the ordinary shareholders and the participating preference shareholders. Because remember, in order to calculate earnings per share, we need the earnings attributable to the ordinary equity holders. This concept of splitting the earnings between ordinary shareholders and participating preference shareholders is best demonstrated by way of an example. In order to demonstrate the split of earnings between your ordinary shareholders and your participating preference shareholders, let's take a look at example 4 in your Notes and Examples handout. The information reads as follows. Capital structure as at 31 December 2019. 500,000 Rand in participating preference shares issued at 1 Rand each, so that means we have 500,000 participating preference shares in issue, with an additional right of 1/10 of the total dividend declared on ordinary shares while as a going concern and upon liquidation. The fixed preference dividend is 10 cents per share per annum. So that whole long sentence essentially means that in essence, participating preference shareholders receive 10 cents per share per annum in a fixed dividend, as well as 10% of the ordinary dividend declared. They also have 1 million Rand in ordinary shares, which were issued at 25 cents each, which means that there are 4 million ordinary shares in issue. There have been no issues of shares during the year ended 31 December 2019. So that means your share capital was stable during the year. Retained earnings as at 31 December 2019. In 2019, this entity had a profit of 400,000 Rand, ordinary dividends of 120,000 Rand were paid, and preference dividends paid amounted to 62,000 Rand. In the comparative year, in the 2018 financial year, there was a profit of 450,000 Rand, ordinary dividends paid of 100,000 Rand, and preference dividends paid of 60,000 Rand. Let us first take a look at the comparative year, the 2018 financial year. The profit for the year amounted to 450,000 Rand. We know that in order to calculate basic earnings, we take the profit or loss for the year after tax and we deduct non-cumulative preference dividends actually declared. We know that preference dividends were paid and declared in the 2018 financial year simply because we were given the fact that preference dividends were paid in the retained earnings column provided to us in the information. And therefore, we can deduct the preference dividends in order to get basic earnings. Importantly, in relation to participating preference shares, we would only deduct the fixed portion of the preference dividend in order to get the basic earnings. We know that there were 500,000 participating preference shares in issue throughout the year, and the fixed dividend amounts to 10 cents per share. Therefore, the fixed portion of the preference dividends amounts to 50,000 Rand. If we take the 450,000 Rand profit less the 50,000 Rand fixed dividend, that then gives us basic earnings of 400,000 Rand. Now we have to do the split between ordinary shareholders and participating preference shareholders. Participating preference shareholders, in addition to their annual fixed dividend, are also entitled to 1/10 of the total ordinary dividend declared. Therefore, essentially, participating preference shareholders are entitled to a portion of the basic earnings, as ordinary dividends are declared based on the earnings for the year and how well the business has done or how well the business has perceived themselves to do. The perception of how well a business is done is largely reflected in the amount of earnings. Ordinary shareholders are entitled to 100%, and participating preference shareholders are entitled to 10%. That means that the basic earnings actually amounts to 110% and must be split 11 ways. Therefore, ordinary shareholders are entitled to 10/11ths of the basic earnings of 400,000 Rand, and participating preference shareholders are entitled to 1/11th of basic earnings of 400,000 Rand. That means that the basic earnings attributable to ordinary shareholders of 363,636 Rand will be used in the calculation of earnings per share. In order to make sure we understand the concept, let's now take a look at the current financial year, the 2019 financial year. The profit for the year amounted to 400,000 Rand. We know that in order to calculate basic earnings, we take the profit or loss for the year after tax and we deduct non-cumulative preference dividends declared. We know that preference dividends were paid in the 2019 financial year because we were told that preference dividends paid amounted to 62,000 Rand. And therefore, we can deduct the fixed portion of the preference dividends in order to get basic earnings. Remember, in relation to participating preference shares, we only deduct the fixed portion of the preference dividend in order to get basic earnings. We know that there were 500,000 participating preference shares in issue throughout the year, and the fixed dividend amounts to 10 cents per share. Therefore, the fixed portion of the preference dividend amounts to 50,000 Rand. That then gives us basic earnings of 350,000 Rand. Now we have to do the split of basic earnings between the ordinary shareholders and the participating preference shareholders. Participating preference shareholders, in addition to their annual fixed dividend, are also entitled to 1/10 of the total ordinary dividend declared. Therefore, essentially participating preference shareholders are entitled to a portion of basic earnings as ordinary dividends are declared based on earnings for the year and how well the business has done. This perception of how well the business is done is largely reflected in the amount of earnings according to users. Ordinary shareholders are entitled to 100%, and participating preference shareholders are entitled to 10%. That means that the basic earnings must be split 11 ways, because 100% plus 10% gives you 110%. Therefore, ordinary shareholders are entitled to 10/11ths of basic earnings of 350,000 Rand, and participating preference shareholders are entitled to 1/11th of basic earnings of 350,000 Rand. That means that the basic earnings attributable to ordinary shareholders of 318,182 Rand will be used in the calculation of earnings per share. Now, if you go and take a look at example 4 in your notes and examples handout, at the bottom of the example, they go about calculating the basic earnings attributable to ordinary shareholders in a slightly different way if you had been given less information than what was actually given to you in a question. So to make sure that you understand this concept fully and how exactly to go about the calculation when you do have certain pieces of information and when you don't have certain pieces of information, I would recommend that you strongly go and go through this example once again from the beginning. That then brings us to the end of today's lecture. I know we are under the 50 minutes, which I'm sure you are grateful for today. Please, however, use this additional time in order to go through all of the examples as required based on your daily work schedule. And then please also take a look at the questions, if applicable, that you can take a look at based on today's lecture content.